Insurance. It's a word that evokes a sense of security, a promise of protection against life's uncertainties. But have you ever stopped to wonder how these companies, the guardians of our well-being, managed to stay afloat while providing financial aid during our most vulnerable moments? The answer, like many things in the universe, is surprisingly simple yet profoundly complex. Insurance companies are the architects of financial safety nets. They provide a cushion, a buffer against the unexpected turbulence of life. From car accidents to house fires, from illnesses to natural disasters, insurance policies offer a financial lifeline when we need it most. But these lifelines come at a cost. A calculated risk assessment that forms the bedrock of their business model. Think of insurance companies as grand cosmic casinos, but instead of roulette wheels and blackjack tables, they deal in probabilities and risks. They use complex algorithms and vast pools of data to calculate the likelihood of events occurring. By understanding these risks, they can determine the price individuals and businesses pay for their peace of mind. This price, my friends, is what we call the premium. Premiums are the lifeblood of insurance companies. These regular payments made by policyholders form the primary source of revenue for these financial institutions. But unlike a cosmic black hole that relentlessly consumes everything in its path, insurance companies don't simply hoard these premiums. Instead, they use a portion of this income to pay out claims, fulfilling their promise of protection when disaster strikes. Imagine a vast ocean of premiums constantly being fed by rivers of payments from policyholders. From this ocean, insurance companies carefully draw out funds to compensate those who have suffered losses, ensuring that the system remains solvent and capable of fulfilling its obligations. But what happens to the premiums that aren't immediately used to cover claims? This is where the magic of investment comes into play. Insurance companies are not just in the business of managing risk, they are also skilled investors. They understand that the premiums they collect represent not only a promise of protection, but also an opportunity for growth. Just as a single star can ignite a chain reaction, creating a dazzling nebula, so too can insurance companies leverage premiums to generate additional income. By investing these premiums in a diversified portfolio of assets such as stocks, bonds, and real estate, insurance companies aim to grow their funds over time. This investment income helps to offset the cost of claims, ensuring the long-term sustainability of the insurance model. Imagine premiums as seeds planted in the fertile ground of the financial market. With careful nurturing and a bit of cosmic luck, these seeds can sprout into towering trees of profit, providing shade and sustenance to the insurance ecosystem. While premiums and investment income form the foundation of an insurance company's revenue, there's another crucial piece to this cosmic puzzle: underwriting profit. This profit, the lifeblood of the insurance industry, represents the difference between the premiums collected and the claims paid out, along with the associated administrative expenses. Underwriting is both an art and a science, requiring a delicate balance between risk assessment and pricing strategy. Insurance companies employ teams of skilled underwriters who use sophisticated algorithms and vast databases to evaluate risks and determine appropriate premium rates. Imagine a cosmic scale carefully balancing the weight of premiums on one side and the potential cost of claims on the other. Underwriting profit is the delicate equilibrium point where the scale tips slightly in favor of the insurer, allowing them to operate profitably while still fulfilling their obligations. Section 5. The role of intermediaries: navigating the insurance landscape. In the vast and often confusing universe of insurance, intermediaries serve as celestial navigators, guiding individuals and businesses through the complexities of choosing the right coverage. These intermediaries, like PolicyBazaar, act as bridges between policyholders and insurance providers, simplifying the process of finding and purchasing insurance policies. Just as a telescope helps us navigate the night sky, intermediaries provide clarity and guidance in the often overwhelming world of insurance. They offer a one-stop shop for comparing different policies, understanding coverage options, and selecting the best fit for individual needs and budgets. intermediaries play a crucial role in increasing insurance penetration, particularly in emerging markets where the concept of insurance might be relatively new. They act as educators, demystifying insurance and making it accessible to a wider audience. Section 6. Revenue streams for intermediaries, commissions, leads, and more. Intermediaries, like stars in a constellation, generate revenue through a variety of avenues. The most common source is commissions earned from insurance companies for every policy sold through their platform. These commissions are typically a percentage of the premium paid by the policyholder. In addition to commissions, intermediaries also generate revenue through lead generation. They collect information from potential customers and sell these leads to insurance companies, who then reach out to these individuals with tailored policy offers. Furthermore, some intermediaries offer value-added services such as policy management, claim assistance, and financial advice, for which they charge a fee. These additional revenue streams help intermediaries enhance their profitability and provide a more comprehensive suite of services to their customers. Section 7. The balancing act weighing profits and promises. Both insurance companies and intermediaries face the constant challenge of balancing profitability with their fundamental promise of providing financial protection. It's a delicate dance on a cosmic tightrope where one misstep can have significant consequences. Insurance companies must carefully manage their risk exposure, ensuring they collect sufficient premiums to cover potential claims while remaining competitive in the marketplace. Setting premiums too high can deter customers, while pricing them too low can lead to financial instability. Intermediaries, on the other hand, must balance the need to generate revenue with their responsibility to provide unbiased advice and recommend policies that truly meet their customers' needs. Favoring one insurance provider over another for higher commissions can erode trust and damage their reputation. Section 8. Trust as currency, the foundation of insurance. In the grand cosmic tapestry of finance, trust is the invisible thread that binds everything together. This is especially true in the insurance industry, where the very foundation of the business model rests on the promise of financial protection during times of uncertainty. Insurance companies must earn and maintain the trust of their policyholders by operating with transparency, fairness, and integrity. They must honor their commitments, process claims efficiently, and communicate clearly with their customers. Similarly, intermediaries must prioritize building trust with their clients by providing unbiased advice, transparent fee structures, and exceptional customer service. When trust is broken, it can be incredibly difficult, if not impossible, to repair. Ultimately, the success of the insurance industry depends on its ability to provide genuine value to individuals and businesses, offering them peace of mind and financial security in a world filled with uncertainty.